Every DCF model claims to find fair value, but they don't all work the same way. And most of them have a serious problem. Let me show you exactly what I mean. The classic DCF model, the one taught in every finance course, takes analyst estimates as its starting point. Revenue forecasts, earnings projections. The problem? Analysts are wrong a lot. Studies show consensus estimates miss by over 25% on average. You're building a precise mathematical model on a shaky foundation. There are 5 main approaches. Classic DCF, analyst estimates, simple, widely used, analyst bias baked in. Damodaran DCF, academically rigorous, but dozens of manual inputs, each one a source of error. Reverse DCF flips the question, what growth rate does the current price imply? Useful, but tells you what the market thinks, not what the company is worth. Multiples adjusted DCF adds sector comparisons, but depends entirely on the quality of your comparison set. The Duel model takes a different approach entirely. Every single input comes from SEC EDGAR, official company filings. 10K, 10Q. No analyst estimates. No management guidance. No opinions. The growth rate comes from the actual 3-year revenue CAGR as filed. The cash flows come from the actual cash flow statement. You cannot manipulate a number that's already been submitted to regulators. But here's what makes the Duel model genuinely different. 3 quality adjustment layers that most models don't have at all. First, the Sloan ratio adjustment. If a company's earnings look great on paper, but the cash isn't there, the Sloan ratio catches it. A high positive Sloan ratio triggers a growth slowdown in year 1 to account for earnings quality risk. Second, the ROIC multiplier. A company generating 50% return on invested capital gets a different growth trajectory than one generating 4%. Capital efficiency is rewarded or penalized in the model. Third, the FCF margin multiplier. Free cash flow margin above 20%. Additional upside. Negative free cash flow margin? The model pulls back accordingly. The WACC, the discount rate, is calculated using CAPM, but instead of using a published market beta, the Duel model derives beta from the ROIC tier. High ROIC means lower operational risk, lower beta. Low or negative ROIC means higher risk, higher beta. This makes the discount rate responsive to the actual business quality, not just to stock price volatility. And critically, the algorithm is identical for every single company. NVDA and AMD run through the exact same logic. That makes comparisons meaningful, not just numbers on a page. Now, every model has limitations, and this one is no different. Growth is capped at 35% annually. For companies like NVDA with 100% revenue growth, the model is conservative by design. There are no macro inputs, interest rate cycles, sector rotations. And the model uses trailing data, not forward guidance. What it gives you is a disciplined, objective baseline, not a prophecy. Every DCF report on duelstocks.com shows the full methodology. Every formula, every adjustment. You can see exactly why the number came out the way it did. That transparency is the point.